You probably spend a lot more time thinking about commodities than you realize. From the cup of coffee you drank for a morning boost to the fuel that helped get you to work. Commodities are raw materials that get harvested and refined into things people use every day. From soybeans to cooking oil, crude oil to gasoline, precious metals to jewelry, and much more. Commodities can be an important part of an investment portfolio because they often perform differently than other assets, which can provide greater diversification. They may also help protect a portfolio from inflation because commodity prices often rise when costs spike. And for active traders, the volatile nature of commodities can offer potential opportunities by speculating on their price movement. However, this volatility, which can be extreme at times, means investing in commodities isn't appropriate for everyone. There are several ways to invest in commodities, but first it's important to understand what drives commodity prices. Commodity prices rise and fall depending on supply and demand, which are influenced by the US dollar and supply shocks. The strength or weakness of the US dollar influences commodity prices because many commodities around the world are traded in dollars. A stronger dollar can put pressure on other countries' currencies, which can lead to economic slowdown and suppress demand for commodities. So if the dollar is strengthening, commodity prices tend to fall. If the dollar is weakening, commodity prices tend to rise. This chart compares the S&P Goldman Sachs Commodity Index, or GSCI, to the US dollar index from 2000 to 2022. Notice the inverse relationship commodities have with the dollar. However, other factors can outweigh the influence of the dollar, especially supply shocks. Supply shocks arise when there's trouble getting enough supply to meet demand. During the COVID-19 pandemic, commodities had two supply shocks. First, as pandemic news was emerging, economic activity was halted and commodity prices cratered. Oil prices even went negative briefly while companies tried to sell tankers full of oil. Second, as the economy started moving again and demand rose, many workers couldn't leave home to harvest or ship commodities. Some supply chains were completely shut off, causing commodity prices to rise quickly. Supply chain issues aren't new, but they usually occur during extreme weather or other natural disasters. Supply chain issues can also be stirred up by political factors, such as the turmoil caused when Russia invaded Ukraine in 2022, upending Ukraine's commodity-driven economy. Sanctions from countries in the European Union that blocked Russian oil and gas added to the commotion. Other factors can also restrict the supply of commodities, such as competition and specialization. For example, not many companies specialize in the extraction of lithium, in part because of the high barrier to entry. This constraint on supply, combined with greater demand as more people bought electric vehicles, caused lithium prices to rise dramatically in 2021 and 2022. Additionally, government policies can restrict supplies by limiting the number of drilling and mining permits, blocking access to government lands, or banning harvesting in certain areas. When supplies are limited and demand is high, commodities can experience a bull market. Sometimes these bull markets can be extended into what's called a supercycle, meaning prices stay high for a long time. According to the National Bureau of Economic Research, a supercycle can last 20 years or longer. During a supercycle, commodities often outperform stocks. This chart compares the GSCI to the S&P 500 from 2000 to 2022. Below the chart, the relative strength indicator gives you an easy comparison of the two indexes. When the relative strength line rose in the 2000s, commodities were doing better than stocks. There are lots of ways to get exposure to commodities. Your goals will likely influence the investment vehicle you use. For example, you could choose to own stocks in sectors that harvest and sell commodities, such as energy and basic materials. If you're forecasting a prolonged bull market, you could also invest in industrial stocks because heavy machinery is needed to harvest, move, and refine materials. There are also mutual funds and ETFs that focus on specific commodities, as well as funds that focus on stocks in the energy or materials sector. Some active traders might be interested in speculating on specific commodities with futures contracts. A futures contract is an agreement to buy or sell a commodity at a specified price sometime down the road. The buyer or seller of the contract makes a profit or loss depending on the changes in price. These traders are often attracted to futures because they're highly leveraged and can result in large gains. But it can also quickly lead to very large losses with small price movements. However you might choose to invest in commodities, remember, they're usually more volatile than other more traditional assets, which can add greater risk to a portfolio despite potentially improving diversification. Carefully consider how much of your portfolio you want to devote to commodity-related investments, keeping in mind that higher allocations may reduce the diversification benefits. No matter how hot or cold commodities get, it's important to focus on your individual goals and risk tolerance when investing in this asset class.
All right, so that's our little primer video. I thought that was a good start for us. And then I will get to some specifics. And as always, anytime you have a question, please feel free to ask that. All right, Chris, since I can see you again, are we on my presentation just to make sure we're in the right spot? Good. Okay, great. Give me 1 second here. Make sure. All right, back to the presentation here. And so what are commodities? We started with the video, and then I want to do real quick, since we're going to be comparing commodities to the S&P 500, or what we'll generally call the stock market. I already got something in the chat here. Could you go back to the graph in the video showing the history of commodities? Chris, I've got a couple coming up here about the Supercycle. So hopefully those will answer your question, so I don't have to go back to the video. So we have the S&P 500 index at an inflection point here. Go back to the late 90s, had the bull run, the dot-com era, maxing out here in 2000. What I want you to really look at here and pay attention to is what the valuation was on the index. 25.2 forward earnings, way overvalued. Came all the way down in 2002 to 14.1. Hit as high as 15.1 in 2007, back down to 10 in the Great Recession. And now we've had that big bull run that culminated with the pandemic recession here, March 23rd, 2020, bottomed out at 13.3. And since then, off to the races, and now in our next bear market. All right, so where do we go from here? Where are we going from? So again, this is our prediction, our specific prediction. But if you look right now where the market's trading, 17.8 times forward earnings, that was at the end of the first quarter, 4,100 in the S&P, trading slightly above that, I believe, today. The NASDAQ in particular is trading 19.24 times earnings. So we think the market is expensive, and we do believe that we are headed into a recession, a mild to slightly moderate one, not a recession like the Great Recession. But we want to be prepared for that. And so again, that's why I decided I think it was a good time to talk about commodities and the diversification that commodities can give you in a portfolio, because of what we call in the business correlation. And commodities, as we'll look at here shortly, tend to be very non-correlated with the equity markets and the fixed income markets. They have their own trajectory, and we'll go over some of those numbers. Here is, and Chris, this may answer your question. This is going back to 1800 in what we call commodity bear and bull market super cycles. By super cycles, as that term they talked about in the video, commodities go through roughly 20 to 30 year time periods where they're either in a bear market, meaning you're not making any money on them whatsoever, or a bull market where they tend to be a very good investment. We believe that the commodity bull market started in 2021 and is now in its very first leg up. And if we look down here at table 1 and table 2, you'll see that the average bull market, without the current one, since we're still in the beginning of it, the average bull market percentage gain in commodities to roughly 250%, and the duration was 17 and a half years roughly. All right, the average bear market cycle is 20 years long with an average drawdown of about 60%. So commodities is really something that you want to know what cycle you're in, whether it's the bear market or the bull market, much more so than the equity index. And again, going back to what the video said, they tend to be a lot more volatile. There's a lot more leverage, and a lot of people have a hard time really understanding the value of commodities in their portfolio, which is what I'm hoping to demystify today. If we look at the bear market, 2008 to 2020 was roughly 12 years long. Not quite as long as the average bear market and a commodity super cycle, but again, things are pointing to or telling us that that trend has reversed, not just price action, but also some of the bigger macro trends, right? So if we look at global commodities in the Bloomberg Global Commodity Index here, we can see 2001 to 2008, we have this massive run of commodities, right? 7-year long and a 220% increase. So it was a huge boon or tailwind to portfolios that had allocations to commodities. Then again, from 2008 to 2021, if you had that same exposure to commodities, it would have been a drag on the portfolio for quite some time. And that's why it's really important to identify as best you can these super cycles. Well, we think you see this downward trending line here. If we take it from here and we downward trend it here, this last roughly 18 to 24 month period has absolutely broken through that trend line and reversed the price action in commodities. So this is what we would call very bullish. Many of you may point to this, recent 20% drawdown. This could just be seen as a pullback to a very interesting entry point into commodities from here moving forward. And we'll talk about why here in a second. So if we take the current, what we believe to be the bull cycle in commodities, and we start it just at the end of 2020, roughly, March 18th, 2020, through 2023, meaning the bottom of the pandemic, where we started to see the supply-demand dynamics in the commodity markets really generate a lot of increase in price action, obviously due to inflation, but also, as the video said, due to those two big supply shocks. Moving forward, what do we think the driver will be in this commodity bull market? We think a falling dollar. During times of recession, economic recession, the dollar gets really strong. We feel that once we get through this recession to fall, and this could be why commodities are falling now, but at a very interesting buy point, that this could be a time for commodities over the next 5, 10, maybe even 15 years to really make a run. And if we compare it to the 1999 and 1971 bull markets in commodities, the last two that we have available, we can see that this trend line is following a very similar path to both of these super cycles in commodities, right? So how do we invest in commodities? A couple different ways, right? We have standard ETFs, we have mutual funds, we have underlying company stock. Well, what do I mean by that? Well, you can invest in a company, let's say a mining company like Anglo American out of South Africa, a big mining, Rio Tinto out of Australia. So these are big mining firms. You can look at a Freeport McMoran if you wanted to be in the United States, FCX. These are big mining companies, metals companies, right? So you can invest in the underlying. If you're interested, obviously energy companies. Oil is probably the most commonly known and largest traded commodity that people are aware of. There's also ETFs that try to mirror the commodity futures. For oil, for example, the 1 month forward contract, or futures contract, is USO is the ticker. And I'm certainly not making a recommendation to anyone about purchasing these. I'm just giving you some of these different ones. You do need to know when you do buy ETFs, just like you do in any of your investing, what you're buying and how it goes up or down. To give you an example, USO, which is the 1 month forward contract of, I believe it's Permian Basin, what is it called, sweet crude. It is very susceptible to two different things that can happen in the futures market called backwardation and Contango. And it can be a value destruction tool if you not understand what cycle you're in. And fourth, you can invest in commodities through the futures market. Now, there's a lot of leverage in the futures market, like the video talked about. So that's something, if you're going to invest in, you better know what you're doing. And, I would suggest professional help if you're looking at the futures market. All right, so what are the risks in investing in commodities? Well, as the video said, volatility, certainly volatility. It's a much more volatile market, or tends to be a much more volatile market than the S&P 500 or the equity market. Liquidity, especially if you're investing in futures, you could have an issue with liquidity or maintaining liquidity. ETFs are obviously much more liquid, but again, I think a lot of ETFs are misunderstood exactly as to how they work, especially when those ETFs are investing in the underlying futures markets. There's leverage, right? Leverage in the futures market, potentially leverage within ETFs that you buy, or potentially leverage in the mutual funds that are investing in commodity futures. You need to know, again, what the underlying holdings are. And then you have these two terms, Contango and backwardation. And you may not have heard of these two terms, but they're terms that describe the current front month contract. And when I say front month, I mean 1 month out to a longer dated contract and what supply and demand is doing to that curve, comparing the front month contract and a later contract, right? So let's go over what that means. So Contango is simply when future price is above the expected spot price, which is the today price. A Contango market is often confused with a normal futures curve, meaning if I'm getting oil delivered in 1 month, it is less expensive than I'm getting it delivered in 10 months because there's a cost of storage or a cost of the volatility of the underlying price of the commodity. So if I want to lock in a price 9 to 10 months down the road, I'm going to have to potentially pay a premium for that or a premium for the storage of that, right? So that's why you get this thing called Contango, where there's a lower price on the spot market, and then the future market or out in the future monthly contracts are going to be more expensive. Now there's the opposite of that, which is called backwardation. And backwardation is when future prices are below the expected spot price. A backwardation market is often confused with an inverted futures curve, right? And this backwardation tends to happen in times of rapid decline in demand or these huge supply shocks. The example the video gave is when, and this is actually a true statement, I remember sitting at my computer in March of 2020 when I was back at Morgan Stanley, and we were watching oil prices fall, not positive, but negative, meaning for somebody to sell you a barrel of oil, they had to pay you $37.60. And the reason was because you had to take delivery of the oil, and if you didn't have a place to store it, because all the ships that were delivering oil, there was so much oil stockpiled in all the reserve places that there was nowhere to put oil. So where were you going to put it? And so they were actually charging a price to take delivery of the oil. A very unique situation, but it shows you how a massive supply shock or a crater in demand can create this thing called backwardation. A futures market is normal if future prices are higher at longer maturities, and inverted if its future prices are lower at distant maturities. If you just think about it logically, right? Things out in the distant, especially if I have a current price today, I have price discovery, I know what it is today at the spot market. If I want to buy out in the future in a normal market, it's going to be more expensive, right? It's very rare for backwardation to exist for very long. And again, this would just be an example of Contango on the top and futures market backwardation here on the bottom, right? And the chart above, and I'll go back to the chart here, the spot price is 60, the normal green line market, a 1 year futures contract is priced at 90. Therefore, if you take a long position in your 1 year contract, you promise to purchase one contract for 90 in 1 year. Your long position is not an option, it's an obligation. Again, that's how you get these crazy reversals in the futures market and in the commodities market, is we don't know what's going to happen 9, 12 months from now, right? We don't know what's going to happen with the war in Ukraine. We don't know what's going to happen with potential economic recession. And there's a lot of variables out there that can determine what the future price is of a commodity. But if you locked in that price today, it is an obligation that you have to take delivery. So the orange line, on the other hand, depicts an inverted market. The inverted market, the futures price for faraway delivery is less than the spot price. And so why would you have a futures curve invert? Just as I've said, fundamental factors such as the cost to carry a physical asset or finance a financial asset, which will inform the supply demand of the underlying commodity. This supply demand interplay ultimately determines the shape of the futures curve. Again, backwardation and then contango. So now you guys know two terms that not a lot of people know in the futures markets. So again, with all this risk, why would we invest in commodities? Well, let's take a look at a really ugly chart if you invest in commodities. See this green box here? That stands for commodity. All right, look at this. From 2012 to 16, it was the worst performing asset each consecutive year. Next to last, barely above last, next to last. One interesting year in 2021 due to massive inflation, 2022. But if we look at the annualized 2008 to 2022, nothing was worse than commodities to invest in, including cash, including emerging markets, including developed markets. But these dynamics begin to change, and you're not worried about what happened over the last 12, 15, 20 years if you're looking at a super cycle. You want to be able to identify the super cycle now so that you can be invested in the next 10 to 15 years when it reverses this trend of commodities being the worst performer, all right? And you can see commodities in 2022 was the #1 performing asset. If you had commodities in your portfolios, like we had in all of ours, at a 5-10% allocation, it was a really, really nice buffer to the absolutely horrible performance of stocks and bonds, right? It was a ballast to those. And that's what I meant when I said at the beginning of the lecture about the diversification into commodities can really help balance out a portfolio. But you also have to be willing to understand what part of the either bear or bull super cycle you're in with commodities, because you really would have wanted to avoid commodities as much as possible in this 12 to 15 year period. So what do we think, or what does the Wells Fargo Investment Institute think about commodities, and what conditions have been met that indicate we are in the super cycle? Well, the current bear matches the shortest record, 12 years, so that condition's been met. Washed out prices, poor absolute and relative performance versus other assets has been typical this cycle, right? Meaning that everyone is sour. The sentiment is, well, washed out sentiment is the next one here. When sentiment gets so horrible in a specific place, that usually means that there's going to be a reversal in price, meaning everyone that hasn't invested in it or wanted to sell their position has sold. That's when you get bottoming sentiment. Feel like that bottoming of sentiment is in the past, and this is a good condition. Strong breadth. Near all commodities have participated in a rally since the 2020 low. One thing I don't know if I mentioned, or I don't think the video mentioned, is commodities are kind of like stocks. They all tend to move together. There's always going to be an anomaly out there. But commodities, whether it's rice, grains, frozen concentrated orange juice, pork leans, hog bellies, oil, gold, silver, palladium, lithium, they all tend to move during super cycles, and whether bear or bull, they tend to move together in lockstep. And we're seeing that happen, and that's why strong breadth definitely is an indicator. Key commodity leadership, gold has broken out over its 2020 all-time high, right? Commodities like silver, corn, copper, soybeans have broken out the cycle highs, so that helps. Price firming, will prices hold consistently above long-term average? Yes, they have been. Rising production costs? Yes. Slow, persistent investment flows? Yes. New demand and restrained supply response, meaning, the supply side, oil has been trading significantly higher than it did in the 2020, obviously hit negative 37 a barrel in 2021, and it stayed elevated, right? And we haven't seen a lot of supply come on, meaning we haven't seen a lot of new projects. In fact, some of the policies out of our government and out of OPEC and some of the other governments have actually reduced supply, which then again drives up prices. All right. So this is probably the most important slide I have on this deck, because I really want you to understand what and how. And this just, I also want to be clear. Alternatives are not commodities per se. Commodities make up the most of alternatives, but alternatives would also include hedge funds and private equity. Whereas, we're mostly discussing commodities today. But to be clear, adding alts to a portfolio, let's say you have an 80 equity, 20 bond portfolio, and just to conceptualize here, we have annualized return over here on the left side, bottom at 6%, 10%, and we're looking from 1989 to the third quarter of 2022. So we're taking a portion of that super cycle in commodities from the last super bull cycle, and we're taking the entire super bear cycle, and now going into the new super bull cycle. So we're taking a lot of bad returns in commodities and alternatives as well. But with each one of these portfolios, whether it's 60% stock, 40% bond here, or it's 40% stock, 60% bond here, or 80% stock, 20% bond here, we take risk back, and in every case, we increase overall performance for this very, very large time frame. So this is 33 years. So this is a pretty good data set. And in each case, whether you have a super conservative portfolio or a fairly aggressive portfolio, adding 30% to alts and reducing from equities, right? If you reduce the equity and bond position here, and if you reduce the equity position solely here, and if you reduce mostly bonds here and part of the equity position, each case we get an increase in performance, which is moving up the scale, right? Add annualized returns. And annualized volatility, meaning risk, we are moving down the scale in risk. So this added diversification of commodities and alternatives is a very, very important part of every single portfolio. And I think it's very important to make sure that no matter how you invest or decide to invest, that you do have some exposure to alternatives, because it's such a great diversifier to a portfolio. One of the problems I think that you see in the Fidelity UC portfolios is you can be very limited on your commodity exposure, because there is a lot of energy in there, and that doesn't all the time coexist with the ESG narratives. And it's important, I think, you can certainly exclude, oil within the commodity space if that's what you want, but don't think of every commodity as, an evil oil company. There's, like I said, gold, there's, food and food companies, right? The ones that are going to provide us all the technology in the future to feed a growing world population, right? With maybe limited resources due to a change in, the planet and all this other thing. I think it's important to understand that investing in these alternatives and these commodities can be very beneficial, and you can do it through the lens that you want to do it through. All right, so let's take a look at gold. It just happens to be one that's breaking out recently. So here's the performance of various asset classes in US dollar bear markets. So if we believe once we get through this recession, let's say third quarter, fourth quarter of 2023, right? And we believe the dollar will fall precipitously after we get through the recession, right? Look at the difference here in a falling dollar, right? The difference between investing in treasuries, stocks, commodities, and gold purely, right? Gold can be a very good diversifier if that's something you're interested in investing in. Let's say you want to exclude energy companies because you don't like big oil, but you do want exposure to the commodity space. This could be a place that you could think of. And then there's a lot of ETFs, mutual funds, all that different stuff that will invest in this space if that is something you're interested in. Here's our correlation and volatility scale based on all the different asset classes. I'm going to take you over here to the right side because this compares gold to all the different asset classes and what the correlation is. Let's think of the number 1, right? So U.S. large caps compared to U.S. large caps, number 1, right? Meaning that they have a perfect correlation in returns. Okay, well, obviously they do, they're the same thing. So how does gold correlate to U.S. large cap stocks? You could see it has a 0.1 or 10% correlation to stocks, which means it gives you really, really good diversification, all right? You could see also from a volatility standpoint, U.S. large cap stocks and gold have about the same amount of volatility in over long-term returns. If you look at gold and you compare it to, let's say, bonds, right? You got about a 0.58% correlation, all right? So not very correlated whatsoever. If you compare it to European large cap stocks, EFA, right? Very little correlation. Emerging markets, very little correlation. So you can see gold becomes a very, very good diversifier in a portfolio. If that's the only commodity that you're willing to have in the portfolio, then that certainly is one that you may want to look at from the standpoint of diversifying out your portfolio further than just stocks and bonds. So covered most of what I wanted to with regards to commodities, about 32, 33 minutes in the presentation here. I just want to finish up with kind of our thoughts going forward because I don't get to see any of you guys for the rest of the summer. Obviously, you can always call me, email me if you have any questions. But I really want to talk about what we think, where we're going to be as we head into the fall, into September, October, all right? Because that's when you'll see me next if you decide to join us for the next presentation in the 4th week of September. Remember what's really, really driving the markets and where the markets are going is the central bank tightening, right? The fastest and longest tightening that has ever occurred, right? This has led sovereign bonds, meaning government bonds, to have the worst year last year, going all the way back to the Marshall Plan into the 50s and beyond. Also a year where we saw stocks fall lockstep, so there was really no ballast. Again, unless you had commodities in the portfolio, which was a ballast, which is further diversification to a long-term portfolio. So that's really what's driving the markets right now. When is central bank tightening going to stop? I don't know. I don't think Jerome Powell knows. It's going to be dependent upon inflation data, dependent on their target inflation rate and where the economy is going. We're starting to see some very, very big cracks in the economy. I think everyone here is familiar with the mid-sized bank failures of Silicon Valley Bank and some other banks in that space. This is something that I discussed in my presentation, I believe, in March. If you'd like to get a little background on that, I would suggest go to the YouTube channel that Vanya hosts, and it should be there. But I don't think, our research team does not think this is over yet. Interest rates, every interest rate move by the Federal Reserve usually takes 6 to 9 months to work its way through the general economy, right? And there's a lot of adjustable rate loans coming due over the next 5 years or so. If you think about how low interest rates were in 2020, 2021 during the pandemic, all the refis that happened, over 50% of mortgages have been refied in the last 2 years. Now that we have interest rates much higher, you think of 5 and 7 year adjustable rate mortgages, those are going to be coming due here in the next 3 to 5 years, right? So we could have, and if interest rates are still this high, that could really, really put a clamp down on people's finances. So something to think about as we move forward. Again, the recession storms, we believe the clouds are gathering, but hope is on the horizon. Here's your average S&P 500 index performance from the calendar days around the recession end. All right, so here's the 0 point, meaning this is when the recession is over, meaning we return to growth in GDP. And about 120 days to 150 days prior is when the S&P 500 bottoms. That's why it's called a leading indicator. And if you wait all the way until the recession's over to really start putting money back into stocks, you missed a huge move in the underlying stock market. So I think it's important, even if we totally believe recession is going to happen, and let's say it happens in third and fourth quarter of this year, that means the market will probably bottom somewhere in August, September, maybe October. So think about that as you make your investment decisions over the summer and going in the fall. I would say certainly be defensive, consider adding commodity exposure, speak to your advisors or whoever you're getting your advice from, but I think you should absolutely consider some of these defensive measures, especially where we sit here now. There's been a very, very nice rally in the markets, but it's really been very concentrated in about 5 technology stocks. And so a lot of the UC funds will have performed well because they're overly heavy in those stocks, but those stocks will also go down significantly in a recession because they are tech stocks that are driven by growth and fundamentally do not have provide, they're not considered value stocks or provide a lot of income for investors. So investors require growth, and if we're in a recession, that's not going to be where you want to be. All right. So again, stocks have historically bottomed on average 4 months before the recession ends. So let's say the recession would end on January 1st of 2024. That would mean, again, a bottoming in somewhere in the August, September timeframe, right? The chart shows the average performance, S&P 500, before and after recession since 1948. Again, we're referencing this chart right here, right? So again, as we move into the fall, right, I'm hoping by the time I do my next presentation in late September, the market's bottom, then we're on our way to the next bull market, but I don't know, right? We're definitely not out of this bear market that started, roughly March, April of last year. So just be careful out there over the summer, be careful in the fall, consider adding some more diversification to the portfolio. Remember that short duration treasuries are paying, 4.5%, 5%. If you're a California resident and you own actual treasuries, not an ETF, you don't pay state income tax on those treasury bills. That can be something that's very attractive. It makes the tax equivalent yield of those T-bills even more attractive because you're not paying state income tax on the interest. And with that, I'm going to close out the 2022-2023. I want to say thank you real quick to Vanya for having me back this year. It's her first full year running this, and I think it's gone pretty smoothly for us, Vanya, and I appreciate all of your help for the last year. Thank you, everyone. I will open up the chat to questions and go from there.
Thank you so much, Ryan. I'm going to review this recording for myself. Just that last session about future things to come, I think is really interesting. But yes, any questions for Ryan?
You could put in the chat or feel free to unmute yourself if you have a question. Also, if there are no questions now and something comes up later, again, I'll put my email and everything up here so that you're more than welcome to. Is that somebody trying to ask a question? I can't tell, Vanya.
I don't see any. Just for myself, could you share any specific topics that might be of interest for upcoming, obviously late September, fall investment interest groups that we should watch out for?
Yeah, I'm looking right now. The only one I have open is November. I've already got September planned, and it's going to be the 6 keys to financial success in retirement. So we're going to go over those 6 things. I think that'll be a good time for it because we'll probably, if I had to guess, I would say the S&P 500 would be lower than it is today. There'll probably be some concerns. September and October are typically the 2 weakest months in the stock market here in the United States. We're going to talk about international diversification, emerging markets that have been laggards that are now turned into leaders. I see Ron Campbell has a question. Ron, go ahead.
Yeah, I'm wondering, specifically about investments in lithium. I think that was something I noticed in your initial slide or video, that that could have an impact locally. I go out to Borrego Springs and out to Salton Sea, and I hear there's huge potential deposits out in the Salton Sea area. Do you have any comments in general about the potential for investing in lithium with the I feel it's going to be maybe a long-term transition over to electric cars, but I think we already see a move by auto companies trying to get in front of that. And it seems like, lithium batteries are, I'm considering a hybrid car for myself that has lithium batteries. So maybe you could comment on that generally.
Yeah, good question. I think if you're asking me about the specific lithium, I think if you continue to see electric or hybrid, as you say, car growth, certainly you're going to see growth in lithium consumption, which is going to require more lithium mining, et cetera, down the list. There's no slowing, I think, the fundamental change from the gas combustion engine to electrical cars. And with that, you will see more and more consumption of lithium. As far as making recommendations on what to specifically invest from a lithium standpoint, I'd like to steer away from that because that's an individual investor question. But you could certainly go on. There's more than likely an ETF that follows lithium. As far as Borrego and all that, I'm not super familiar with that. I mean, I'm familiar with the area, but I'm not familiar with what projects are going on out there. But I think, this is where Google could be your help, and you can search for some of the companies that are doing work out there. And if you wanted to directly invest in the companies, then go through it that way. Just be careful. Understand that, again, as I said at the beginning, commodities and commodity companies tend to be very volatile. And so probably better to spread your risk out through a mutual fund or through an ETF if you can. I see there's something in the chat. What are your thoughts on President Biden's water reduction policy and how it might affect the market? Somebody's trying to lure me into a political conversation. I don't do politics in here. It's something I swore off on day one. I haven't, to be honest with you, I'm kind of lucky on this one because I haven't read his water reduction policy at all. So I'm really not familiar with it. But, fundamentally, if you reduce something, then it drives price up, right? I mean, that's a fundamental economics 101. So I would imagine water rights or, water bills would continue to go higher if that's what the president's trying to do. Fortunately, I'm not super familiar with the president's plan, so I really can't speak to that. All right, I don't see any more. Again, there my email. To answer your question, Vanya, so the 6th, I think, and then in October, I'm going to continue to do what Suzanne had asked me to do a couple years ago. We'll review the 403B and 457. We'll go over all the new limits for 2023, make sure people are contributing. We'll talk about performance of the underlying funds and go over some suggestions on how to properly diversify, all that. And then November, I'm open. So if there's anyone out there that has topics, so that would get us through the fall, Vanya, along with Social Security and Medicare and all those days. So again, the 6 steps for a worry-free retirement in September, and then in October, we'll go over 403B, 457. And I want to wish each and every one of you, thank you, Donna, a wonderful summer. Be safe out there. Enjoy the Ides of Summer. And I look forward to hopefully seeing all of you back here in September. And I'm available all summer. I don't take the summer off, unfortunately. So you can email me or call me at any time. Thank you, everyone. And happy end of 2022, 2023. Take care, Vanya. Bye now.
Goodbye.